Welcome back, everyone. I hope you're having a great day. And in this video, we're going to take a look at the dividend growth stock I've been buying over the past 2 weeks. And I'm going to share an overview of my entire dividend growth portfolio that currently sits at a value of over $105,000. And right now, even as the market trades near all-time highs, I continue to invest my capital into strong blue chip dividend paying companies month after month. And recently I increased my position in the company I believe to be one of the strongest tech names in the world, and that is Microsoft. Currently the second largest company in the S&P 500 with a market cap at $1.94 trillion. And this was the second largest company in my personal portfolio as well. But after I bought an additional 20 shares over the past 2 weeks, it has now become the largest single position with a value of over $16,500. I am a big bull on the company. I think they have an excellent management team that continues to deliver incredible results, and I'm very confident that going forward, we will see continued long-term success coming from Microsoft. So in this video, we're going to take a look at some of the recent headlines surrounding the company, take a look at their financials, and do an overview of my entire dividend growth portfolio, and I'm going to share with you all the companies that I own within each individual sector. But before we can do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today we're going to focus on the number one position in my current portfolio, which is ticker MSFT. So if we take a look at Microsoft, on the 1-year chart, they are up by 38%, and the company currently trades with a forward PE of 33 and a current dividend yield of 0.87%. So of course, buying into this big tech giant, I'm not looking for the current dividend income. This is a long-term player that I believe over the next decade or two will deliver great share price appreciation and some excess capital in the form of that little dividend year after year. And we can see over the past 5 years, Microsoft's total return of over 400% is absolutely spectacular. And this company continues to deliver very strong results, and from my personal perspective, I think they're doing everything right. And why I like this company right now, even though they're near all-time highs compared to the other big tech giants, is because Microsoft has done a fantastic job of getting out of the eye of the government. And currently, Microsoft is the only big tech company that's not getting directly attacked by Congress. If you remember back in July of 2020, 4 big tech CEOs made up of Amazon, Apple, Facebook, and Google were grilled on Capitol Hill over their market power. Congress believes that these tech giants are monopolies in their industry and hurt competition within the United States. Do you see the name that was not included in this scrutiny back in 2020? Microsoft. They were not included, and their CEO was not grilled on Capitol Hill, although they are the second largest company within the tech sector and in the S&P 500. And taking a look to just this past week, the House is working on a bill to break up the other big tech companies. Of course, if this does get passed, I'm sure there will be some impact on Microsoft, but taking a look at the article in the journal, look at the companies that were named. Google, Apple, Facebook, and Amazon. The name you don't see in this article once again is Microsoft. And this new bill is called Ending Platform Monopolies Act. And of course, I'm sure if it goes through, there will be some minor impacts on Microsoft. But again, this is the only big tech company that's not directly named in all of these government interventions. So I really like it as my number one position because I do believe if any of these bills go through, even if it does have some impacts on Microsoft, I don't think it will be as harsh as it will be to the other big 4 companies that were directly targeted by Congress during their investigation. So right now, I believe Microsoft is in a very strong position, and even throughout all of this craziness, the company continues to deliver very positive headlines to really boost the confidence in their investors and their entire shareholder group. And recently, the company just announced plans that they're developing a hardware device to bring their Netflix for game service directly to consumers' TVs. So right now, if you're unaware, Microsoft has their own cloud gaming service called Xbox Cloud Gaming. I am a big fan of this product, and essentially what it does, if you have Netflix, you know when you log onto the platform, you have a large plethora of different options and movies and TV shows to watch. Xbox Cloud Gaming is the same thing, but with video games. No need to directly download any game. You scroll through the platform and all the different titles. You pick a game you want to play and you play directly on the cloud network. So currently this is available for different Android and Apple devices, but it hasn't been directly uploaded to TVs just yet. And that's the next step, and that's where this new product is coming in for Microsoft very soon. I am really liking this idea. I think many gamers still play on their TV, and having a small product plugged in that allows you access to hundreds of different titles for such a small subscription fee, I find very attractive. And of course, if you're subscribed to the channel, you know I am a huge bull on subscription-based revenue models because they bring in consistent, predictable, and growing cash flow year after year into a business. And Xbox Cloud Gaming is focused on a subscription revenue where you pay a monthly fee to have access to this massive title of different games that you can play on demand wherever you want without having to download any of the games individually. So I think this is a huge step for Microsoft in the right direction and a great product hitting the market very soon. And of course, I have discussed this in a recent video, but the company is also making some great acquisitions. They announced they're buying Nuance in a deal worth just under $20 billion to expand their infrastructure in the healthcare and artificial intelligence sector. So Microsoft right now isn't really that deep into healthcare. So this exposure brings them directly into one of the top speech recognition companies that is focused directly on the healthcare sector. And taking a look, a quote from the company's CEO himself during an interview with CNBC directly after the deal was announced, he said, "This deal is about two things: healthcare AI provision, and building on top of the existing partnerships that Nuance has with core healthcare system providers." So right now, before this acquisition, Nuance had direct relationships with some of the largest healthcare companies within the United States. So Microsoft, to get access to those same partnerships, they just bought the entire company. In a deal worth just under $20 billion, Microsoft thought it was a correct price to pay to get access directly to the healthcare networks and get some of the IP and the client base that Nuance already has in existence. So those were two recent headlines surrounding the company that I believe to be very positive and show that they're moving in the right direction and are attacking the growing industries. And finally, a point that I want to share that really lets me be bullish on the company right now is from their Q1 2021 earnings. The company posted their fastest revenue growth rate since 2018. So usually for a lot of big tech companies, over time their growth rates start to decline as they reach a greater scale. But Microsoft, it shows the opposite. Even after the company has already been reached a $2 trillion market cap, they already generate over $100+ billion of revenue year after year, $50 billion of free cash flow. The company's growth is actually expanding rapidly at this current point in time. So I think the fact that we're seeing positive growth rates, the expansion's going faster, their cloud network is booming, and I think overall the company's doing so many good things, attacking so many growing industries, that the overall revenue growth will continue to accelerate over the next few years as well. So Microsoft as a whole is doing a lot of things right. The company's making some great acquisitions. I think they're focusing on the right industries for expansion. The Azure cloud network is absolutely exploding in popularity. And over the past 3 quarters, that cloud network individually has seen 50+ revenue growth quarter after quarter after quarter, which is very, very impressive. And now we're going to take a quick look at the company's financial statements. And in my personal opinion, I believe Microsoft is in the top 3 of the best financial statements out of any company in the world. If we start off with the income statement, we can see that year after year, total revenue continues to expand. From $91 billion in total sales back in 2016, that has grown to around $160 billion in the trailing 12 months, and year after year, it continues to grow. And if we take a look at the bottom line, this is a very profitable company as well. $56 billion of net income over the past year from $160 billion of total revenue, leading to some great high margins, and I think this company will continue to see earnings growth for long into the future. And taking a look at the balance sheet, they are in a very, very strong financial position. Taking a look, total current assets of $165 billion compared to short-term debt of only $72 billion. So that means the company has a current ratio above 2 and it's very, very sustainable over the shorter term. And taking a look, we can see that the company only has $174 billion of total liabilities. So that means with $164 billion of short-term assets, the assets the company has available to them within the next 12 months have the ability to pretty much pay off every dollar of debt on the entire company, which is very, very impressive. And what we can see is that Microsoft's long-term debt has been declining year after year. They've done a fantastic job of reducing the total debt level from around $76 billion back in 2017 to only $50 billion as of their latest report. And the company's total equity continues to grow year after year as well to $134 billion, which is absolutely remarkable. And of course, with a company like this, high margins, growing revenue and earnings, and a strong balance sheet, that leads to some excellent cash flow as well. And jumping over to the cash flow statement, the company's total free cash flow continues to expand year after year as well. From $31 billion up to $38, then $45, and now in the past year, they've generated over $53.7 billion of total free cash flow. $53.7 billion. Currently, the company's entire long-term debt, like we saw, sits at around $50 billion, meaning the cash flow they generated in 1 year has the ability to pay off all the long-term debt on the company and shows how financially stable this name really is. And overall, if you're unaware, there are only 2 companies in the world that have a higher credit rating than the US government. And the 2 companies are Johnson & Johnson, the healthcare leader, and of course, Microsoft. 2 companies have a higher credit rating than the US government, and Microsoft is one of those names, showing how stable and how sustainable this company really is. And going forward, analysts are bullish on the stock as well. They're forecasting around 17% annual expansion in share price, and at this current level, the stock is considered a strong buy, coming in at a 1.6, and the $257 share price is below the 12-month expectation of $293, implying another 15 to 20% upside from where we currently sit at. So I think Microsoft is one of the strongest companies in the world, if not the strongest. I like that the company's not getting directly attacked by Congress. Their CEO is not presenting on Capitol Hill, and they're just making some great news headlines. The fact that they're expanding their network for gaming, they're expanding to the healthcare sector, their revenue is flowing up faster and faster quarter after quarter, the cloud network is booming, and there's just so many positives surrounding Microsoft right now that I decided to pull the trigger and make it the number 1 position in my overall portfolio, and it's a company I plan to hold for the very, very long term. And now we're going to shift away from the company individually and take a look at my portfolio as a whole and all of the different companies I own. So if we jump over to Simply Safe Dividends, they give you an overview of my entire financial freedom portfolio. So we can see right now the balance sits at $105,000. This portfolio provides me with $2,111 in annual dividend income with a current yield of 2%, and my yield on cost has grown to 2.43% overall. So of course, taking a look at this portfolio right now, you understand I'm not here for the current high yield. With a $105,000 portfolio, if I was chasing yield, I could easily have between $5,000 and $6,000 of annual dividend income. But I'm here for long-term capital and dividend growth. Because I'm in my early 20s, I have another 30 plus years of investing that I want to buy the best and strongest companies, regardless of the current income yield, because I believe over the long term, that will give my entire portfolio the best total returns, including capital and dividend appreciation. And we can see my 5-year dividend CAGR is at 8.2%, so this current $2,100 is growing at a very fast rate. And right now, 94% of my dividend income is considered likely safe, and 6% is considered borderline. And of that 6%, it's made up of JP Morgan and Bank of America, 2 companies who I personally believe are paying out a safe dividend and not whatsoever considered borderline. And overall, I am diversified across multiple different sectors, but I do have a heavy focus within technology. So that was a quick overview of my entire portfolio. And if we jump in to my actual tracking spreadsheet that I created myself and is available for everyone down below in the description for absolutely free, I will never charge you for access to my portfolio. And if you click that link, you can view all the different companies that I own, my gain or loss in each position, how much dividend income I collect from each holding, whenever you want, for absolutely free, and I will never charge you for this information. So we can see on my Excel, it's very simple, nothing too complex. Company name, how many shares that I own, the current market price for 1 share, and of course the overall market value of the position, my book value, and the gain or loss, and of course the gain in terms of percentage. Then I have the dividend information, and on the right hand side, I also have a chart indicating the 52-week performance of the underlying company. So right away, if we kind of go sector by sector, you will see that I'm heavily weighted toward tech. My big tech companies include Apple, Microsoft, Visa, MasterCard, Broadcom, Taiwan Semi, and Qualcomm. So I own a bunch of different companies within the tech sector that have very different operations. And first, we're going to start off with Apple and Microsoft. I don't need to explain what these companies do because I'm sure you're all aware. Two major tech giants, Apple leads the game as the largest company in the world, followed by Microsoft coming in at number 2. Then in the tech sector, of course these are somewhat of a fintech name, we have Visa and MasterCard. Both of these companies dominate the credit and debit card industry, and owning both in a portfolio gives you access to around 80+% of that entire market. Then my last 3 tech stocks come in the form of semiconductors. Broadcom, Taiwan Semi, and Qualcomm all operate within the semiconductor industry, and overall, I'm very bullish on that expecting to grow. There's a major chip shortage right now. These companies are in high demand, and all 3 have seen accelerated revenue over the past 12 months, and analysts are forecasting that for the next 5 years, the revenue growth for these companies will be absolutely remarkable. So I own a little bit of each to diversify myself across the entire dividend-paying semiconductor industry. Then going forward, I have my financials. I own JP Morgan Chase, Bank of America, the 2 largest US banks by market cap, and then I also own Royal Bank of Canada and TD Bank, the 2 largest Canadian banks in terms of market cap in the Great White North. And then my 5th financial company is BlackRock. We all know the company through their iShares ETFs. They're a major asset manager with over $9 trillion in AUM, and I like the exposure the company has to the global market. I think the company has a great mix between institutional, retail, and commercial investors, and I think over the long term, they perform well. They have growing revenue and income year after year. Just another company I want to own in my own portfolio. Then, of course, we jump into communications. I only own one company, and that is Verizon. I sold out of my AT&T stock after they sold out of their Warner Media division, and now I'm only left with Verizon for that high current income and slow growth over the longer term, and with a yield above 4%. This is pretty much a pure income play within my portfolio. Then we jump over into the healthcare sector. I have AbbVie, Johnson & Johnson, Merck, and Pfizer. So 4 companies, again, all from the overall healthcare sector, but a mixture between traditional medical devices and big pharma sales. So I like the exposure. They all provide some nice growing dividend income year after year, and pretty much just some blue chip companies within the overall healthcare sector that are boring and I believe will provide consistent long-term returns. Then we move on into consumer discretionary. I only own 2 companies within this sector, and they are Home Depot and Lowe's. I am a big believer that these 2 retailers will continue to be successful long into the future, even as e-commerce continues to grow and become a larger part of consumers' way of spending. I think the products that these 2 companies sell are really going to be in-store, in-demand type goods. I think it's going to be very hard for consumers to plan out their home renovations directly online without seeing the different products available to them in-store, touching them with their own eyes. So I think right now, these are 2 retailers who are still going to benefit even as e-commerce continues to grow and will remain a leader in the retail sector. And once again, similar to MasterCard and Visa, because I don't know exactly which one's going to outperform the other going forward, I have no problem just buying both. In our way of trading right now, with no fees, no commission trading, it's very easy to just buy both companies and split your capital between the 2. Next, we're going to have the consumer staples. I have Costco, Pepsi, Procter & Gamble, and Kimberly-Clark. And personally, as a very boring conservative dividend investor, I love my consumer staple companies. First, we have Costco, a major retailer that I go to myself. I spend a lot of money shopping at the store, so I have to own the stock. The performance has been spectacular, and I just believe the company and their infrastructure will continue to perform very well over the longer term. Second, of course, we have Pepsi, the major consumer player that sells different beverage and snack food products. And I think going forward, they have over $25 billion brands under the Pepsi ecosystem. They're nicely diversified, and if you're unaware, they actually generate more revenue from their snack foods than they do their beverages. So many people think of Pepsi as only a drink company when they're much more than just that, and I love holding them in my overall portfolio. And I think currently, Pepsi is the 3rd or 4th largest position with the market value of over $5,000. Then of course, Procter & Gamble and Kimberly-Clark, 2 consumer goods products that sell, the household necessities. Kimberly-Clark owns Kleenex, Procter & Gamble is all the different brands for oral care, health care, hair care, all the goods people buy month after month, and they don't even think about it. They need the goods, so they buy them, and those are the two companies that dominate that industry. And then going forward, I have 3 companies from the utility/energy sector, which include Duke, Southern, and NextEra. Duke and Southern are there for traditional type utility brands that have a nice yield above 4%, and I'm there for the dividend income. Slow and consistent is why they're part of this portfolio, and to kind of reduce the overall volatility. Then with NextEra, they're a player that also operates in the renewable sector. So they have a lot more share price appreciation and faster dividend growth with a lower current yield. So I believe owning the combination of these 3 companies and splitting my capital into one focus on renewable and 2 traditional will allow me to have great diversification within the overall utility sector as well. And if you take a look at how I position myself, $2,000 plus $2,000, just over $4,000 between the 2 traditional utility companies. Then I have $4,000 alone within NextEra. So between the 3 companies, half my capital is split into one of the renewable plays, and the other half is split into the traditional high income producers. And finally, I have Canadian National Railway, which is my only industrial company within my portfolio, and this stock currently trades for $110. This is one of the strongest railroad companies within North America. They have a massive amount of existing infrastructure, and with governments reluctant to continue to grow the network of rails across the country and within North America as a whole, the existing brands I think will be successful long term. There's just so many different types of products that have to be shipped by rail, and if they're not making any more railroads, the companies who are already in that industry will have pricing power over the long term and continue to grow with generating revenue and cash flow for long into the future as well. So this was the final stock in my portfolio, and as you can see, every company I own does pay out a dividend. The range of yields does vary very fast. We have companies like Apple, Microsoft, and Visa who pay out less than 1%, and then we have people like AbbVie who have a yield above 5%. So I have a nice mixture between high income and high growth, and if we take a look at my overall sector diversification, you can see 44% of my capital is within the tech sector, and a majority of that is made up between Apple and Microsoft, 2 of the strongest companies in the world, and I do not feel I'm overweight in that sector whatsoever. I buy companies within the tech sector that I believe have very strong financials. So even if the overall industry has a tough time, these individual companies I don't think will be hurt too bad because they have the underlying capital and financials to continue to suffer through and survive any harsh economic periods. If we see rising interest rates, I think these companies that I own will still perform very well. Then of course I have my financials. You saw the big 4 banks and BlackRock, my consumer staples. We took a look at all those different brands, and I am a bullish, big believer in consumer, very boring companies that provide necessities. Then I have some utilities that we've gone over, some consumer discretionary, a little bit of healthcare, and a small part of my portfolio in communications as well. So although I'm not perfectly diversified, I don't have a cap on what I put into each sector, but I like how I have capital spread out between multiple different sectors, all providing me with growing dividend income. So as a quick overview of my entire portfolio, I hope you understand my investment goal of total return over the longer term period by investing in some companies that I think have great financials, are market leaders, and have the ability to generate consistent cash flow over the longer term. So now we're going to kind of wrap up the video. I want to thank you for watching to the end. Please hit that like button and subscribe if you already haven't done so. And of course, we took a look at Microsoft and a quick overview of my entire portfolio. So thank you for watching to the end. Please hit that like button, join the community and subscribe, and I will see you in tomorrow's video.